Hello guys, in this video we are going to explore the income statement, its structure, elements, and why it is such an important tool in financial reporting. The income statement tells the story of a business's performance over time. It follows accrual accounting, recording revenues when earned and expenses when incurred. It's like a movie of business activity. Now let's walk through the multi-step income statement, which shows the breakdown of a company's profitability step by step, from core operations to any unusual activities. Revenues and cost of goods sold. Revenues are the total sales the company makes from its main business. We subtract the cost of goods sold. That's the direct cost of producing the goods. This gives us gross profit, the first important profitability figure. Example: if we sell cakes, revenue is from cake sales. Cost of goods sold includes flour, sugar, etc. 2. Operating expenses and operating income. From gross profit, we subtract selling, general, and administrative expenses. These are the overheads like salaries, rent, advertising. What remains is operating income. This reflects the profitability of the company's core business. This is also called EBIT, earnings before interest and taxes. 3. Non-operating items. Now we add interest and dividend income, money earned from investments or bank interest. Subtract interest expense on loans and debts. Also, include non-operating gains or losses, like selling old machinery or foreign exchange gains. These items are not part of the company's everyday operations but still affect total profit. 4. Income from continuing operations before tax. This is the subtotal before we account for taxes. We subtract the provision for income taxes to get the income from continuing operations. 5. Discontinued operations. If the company shut down or sold a division, that income or loss goes here. We include gain or loss from operations of the discontinued business, gain or loss on its sale, and tax effects. These are shown separately so we know what income will not continue in the future. 6. Net income. Finally, we reach net income, the company's bottom line profit after all expenses and adjustments. This is the most commonly watched number by investors and shareholders. Conclusion. This detailed format helps users clearly see where the company earns and spends its money, from everyday operations to rare or one-time events. Let's start at the top. Revenues are the total money earned from sales. For example, if a bakery sells cakes for a total of $100,000 in a year, that's its revenue. Now, to earn that revenue, we must spend on ingredients like flour, sugar, etc. These direct costs are called cost of goods sold, which is $60,000 here. So, gross profit equal to revenue minus COGS, equal to $100,000 minus $60,000 equal to $40,000. Next, we deduct all regular business expenses, like admin salaries, rent, electricity. Let's say they cost $10,000. This gives us the operating income, which is $30,000. This tells us how profitable the business is from its core operations. Now we add or subtract items that are outside day-to-day operations. Example: suppose we earned $2,000 interest from a bank deposit. We paid $1,000 interest on a loan. We also sold some old equipment and made a $1,000 gain. Adding and subtracting these gives us $30,000 plus $2,000 minus $1,000 plus $1,000 equal to $32,000, which is income before tax. We then subtract income tax. Let's say it's $8,000. That gives us income from continuing operations equal to $32,000 minus $8,000 equal to $24,000. This is the profit from the parts of the business that are expected to continue. Sometimes, a company shuts down or sells off a part of its business, for example, selling a bakery branch in another city. Let's say that branch earned $5,000 before being sold. The company made a $3,000 gain on selling it, and paid $2,000 in tax. So, income from discontinued operations equal to $5,000 plus $3,000 minus $2,000 equal to $6,000. Finally, we add continuing and discontinued income, Net income equal to $24,000 plus $6,000 equal to $30,000. This is the final profit the company made for the year. Operating income shows profit from core business. Non-operating items include things like interest and one-time gains. Discontinued operations must be shown separately to reflect what won't continue. Net income is the final result after everything. Now let's discuss benefits and limitations of income statement. First, the benefits. One of the biggest advantages of the income statement is that it helps predict future cash flows. By looking at a company's past performance, we can make more informed guesses about how it might perform in the future. Next, it allows us to assess performance. The income statement shows how well a company is doing over a certain period. Are they making a profit? Are expenses under control? It gives us a clear snapshot of operational results. It also helps in evaluating risk and uncertainty. When we study trends in income and expenses, we can get a sense of how stable or volatile a business might be. This is especially useful for investors and decision makers. Now, while the income statement is helpful, it does have its limitations. First, it relies heavily on estimates and assumptions. Things like depreciation or expected losses are not exact. They're based on what management thinks will happen. Another limitation is that it's affected by accounting methods. Different companies might use different rules for how they record income or expenses, which can make comparisons tricky. Also, there's a lot of judgment involved. Management decisions about when to record certain items can influence the numbers we see,